everyone. Thanks for joining us for episode 26 of Takeaways. My name is Patrick Searcy. I'm Director of Marketing for ALN Apartment Data, and I'm joined by the star of the show, Jordan Brooks, Senior Market Analyst. Jordan, how are you?
I'm doing great, Patrick. How about you?
I'm doing very well. I'm excited to talk about this article from the September newsletter. It's called Growth Market Showing Up in New Construction Data. Recent deliveries. Some of the usual suspects remain at the top of that list, but you did mention in the article some atypical markets with strong in-migration over the recent years that are higher up on that list and for units under construction. Can you talk a little bit more about that dynamic with us?
On the deliveries side, in a typical year, we're talking about, if we're looking at the top of the list for new deliveries, markets like New York, LA, Dallas, Fort Worth, Houston, and those markets, when we're looking at deliveries so far this year, so through August, are at or near the top of the list still. But one of the main changes we've seen from recent years is the addition of some of these, as you said in the question, some of these high growth markets over the last few years. So I think probably the best examples, Phoenix, Tampa, and Nashville. Not only are all three of those markets in the top 10 for deliveries this year through August, but all three also have delivered more units than their 3-year average for this period. And so both relative to other markets in the country and relative to their recent past, these are markets that are especially active in terms of deliveries. And that's a positive development for those markets just kind of broadly, because they've sort of seen the good and the bad of explosive growth over the last few years. And so it's encouraging to see these markets sort of ramping up their new development to regain a little bit of a equilibrium in terms of the supply and demand balance in those areas. And then, as you mentioned too, the same dynamic sort of holds true on the under construction side. So these are projects that are currently under construction but not yet leasing. And if you look at top markets in terms of under construction units as a share of their existing stock, what you see is markets like Boise, Myrtle Beach, and Miami at the top of the list. Again, three high growth markets in recent years. And then if you instead look at under construction units just sort of as the total number of units in the pipeline for that sort of stage of the process, you do see sort of, again, your typical large markets at the top of that list. But you also see areas like Austin and Orlando, which again are sort of two of those markets at the tip of the spear for growth and for rent gains over the last couple of years. And so, overall, we are seeing a move toward increased development in these areas that really have needed it over the last few years.
Well, on the flip side of all this, were there any markets with more units on the way than would maybe be expected given their recent performance?
You could probably make a case for New York. New York ended August with average occupancy down at 90%, which is significantly lower than the national average. They've also lost more than 1% in average occupancy this year. They've had some less than ideal net migration numbers over the last few years. So that's probably one you could point to. But again, it's New York, and it's a little bit like LA in that because there are so many people there, you're not as concerned about a sustained oversupply issue. The California Bay Area, though, would be maybe another one to point out. Average occupancy, it remains higher there, certainly compared to New York. It's about 93%, which is right on the national average. But if you look at their under construction units as a percent of their existing stock, it's a little over 40%, which is a big number, particularly for a market that we wouldn't really categorize as a growth market. Negative population growth in recent years, and it was an area of California during the pandemic period that even relative to other parts of California struggled a little bit. So that would be another one I would point out. And then the caveat would be, of course, that construction times are continuing to grow. We've written about that recently as well. And California is probably exhibit A in terms of long construction times for multifamily development. So that is something that San Francisco would have going for it, is that these under construction units are going to take a little bit more time to enter the market, and that will smooth the deliveries a little bit than compared to how it might be in other parts of the country or in recent years where construction wasn't taking so long.
This month's article is all about the new supply. So where do we stand nationally as we look ahead to the end of this year?
Well, new supply so far this year has been a little bit lower than last year, but still higher than in 2019 or 2020. So we're kind of right there in a normal range for year to date deliveries. As I said, the average construction duration is continuing to prolong. We're now seeing the cost of capital rise, and that may sort of decrease the number of projects we see breaking ground, at least in the short term. But we still have quite a bit of average occupancy sort of buildup from last year when we had way more absorption than new supply. Even as bad as apartment demand has been this year, and it has been, just for some context, last year we absorbed over 600,000 units nationally. This year nationally through August, we're not even at 100,000 units. We're at somewhere around 95,000. So even with demand being that much lower, we've still only lost about 1 percentage point in average occupancy. We've gone from 94% to 93. So given that we've only got 4 months left of the year, it seems like we're likely to close the year with occupancy still a little bit higher than is typical sort of in the pre-pandemic period. And that is going to continue to provide a little bit of upward momentum for rent growth. But having said that, it's pretty clear that we've passed the peak of rent growth.
Well, again, at the time of this recording today, you'll be back in Dallas at the end of this week for the AAGD State of the Industry, that for the first time is also doubling as their business exchange. I know you'll be speaking at that. Can you give us a little preview if that's not too top secret? And if that is, then what else do you have coming up?
No, that's top level security clearance stuff is how that usually goes. But no, I mean, it's always nice to talk in a market that in many ways sort of is the leading edge of the multifamily industry. When we talk about new supply and apartment demand, and Dallas is always right there at the top. So looking forward to that for sure. And then after that, in a couple of weeks on October 13th, I'll be doing the Appfolio virtual AIM conference, just a short little session there, I think about 15 minutes. But that's going to be kind of a quick little hit of information, but useful for sure. And then October 19th, I will be speaking at the Mid-Florida Housing Summit in Tampa. And that's going to be a live event. So viewers of this that might be in that region, definitely check that out. And registration information for all of these will be on our social media channels. And then, of course, always check on the blog, alndata.com/blog. We've got some good content planned for that as well.
You're right. Keep an eye out on our social media. You can follow us on Twitter at ALN APT Data. You can also search for ALN Apartment Data on Facebook and on LinkedIn. We are obviously here on YouTube, so make sure that you're clicking that subscribe button and hit that notification bell so that you don't miss any of our new content as it's released here on YouTube. Jordan, thank you so much. I know you got a very busy schedule this week, so I really appreciate the time that we have together today to talk about our newsletter article. And we'll see you here soon enough.
I'll see you in October.